Hey everybody, I hope everyone is doing well and had a good day. In today's video, we're going to review the E-mini S&P 500 5-minute chart for Wednesday, July 22nd, 2026. Look at the daily chart first, higher time frame. The market is in a fairly tight trading range here. Average daily range has been about 75 points, but over the past maybe 10 days, it's been really between maybe 45 and 75 points. So the bars are getting smaller here. And going into the day, like I said, tight trading range, sort of in the middle of the range. So I expect there to be sellers above the prior bar's high and buyers below the prior bar's low. Although the sellers may not come in directly above the bar, they may come in higher in the range. Then here's the 5-minute chart. Going into the day, the market gapped down far below all the bars to the left in this fairly tight trading range at the end of yesterday, and that's good for the bears. However, the bears were unable to get a follow-through bar on the open. So bar one, it's a bull reversal, a bull trend bar. The gap down still may need to get a second leg down because if you think about it, in this tight trading range, there's limit order bulls buying with limit orders at the bottom of the range, in theory, getting trapped by the bear breakout, the gap down, and that creates resistance in this area. But bar one is a strong enough bar that it may need a second leg up of its own. Because again, in theory, there's sellers on the open, and those who sold on the open of the day are trapped by bar one. Bulls get a follow-through bar, but it's an inside bar, so trading range on bar two. Strong enough momentum, like I said, on bar one that will probably get a second leg up, but resistance above, so also probably will get a second leg down. And we're continuing up here, channeling up on bar 3 and 4, testing resistance. Lower time frame chart, this is a spike and channel with 3 pushes up, either bar 1 or 2, pullback 3, pullback 4. But the channel is tight. It's a micro channel on the 5-minute chart, which means the first reversal will probably be minor. So instead of there being strong sellers below bar 4, there's probably buyers below bar 4. So yes, gap down, it's a bear breakout, and then a pullback to the moving average, but there's probably buyers below 4. Bears probably need a second entry short. And then 5 goes outside up. So good for the bulls, bull bar closing on its high. Should mark the prior day's low. So the prior day, market usually breaks out above or below the prior bar's high or low. That goes for any chart. The daily chart is no exception. So you expect the market to test the prior day's high or low most days. At this point, we have a rally, tight channel for the bulls, and we're closer to the high. So that's a magnet that the market is probably going to get to. The question is what will happen when we get there? And the expectation on the higher time frame chart is that there will be sellers at yesterday's high. But in this moment, bar 5, really hard to make an argument for selling at this moment. It's a pretty strong bull rally, tight channel. 6 looks like a give up bar. Any traders that were selling are giving up. They're looking to sell higher. The market has to move quickly to higher prices to attract sellers. So pair of bull bars, 5 and 6, good for the bulls with a magnet just above, probably going at least a little bit higher. The problem is the closer we get to the magnet, and once we get to the magnet, the magnetic effect can just be turned off in an instant. And the magnet that is attracting price to it, yesterday's high, can quickly become resistance, and the market can fail to break out through it and then reject it. So bar 7, small bull bar closing on its high, still probably going to test yesterday's high. But let's see, can the bulls actually break out above yesterday's high? And then can they get a follow-through bar closing above yesterday's high? Instead of breaking out strongly, we get a strong bear reversal bar on 8. It's a tight channel, bars 1 through 7. So good for the bulls. The first reversal will probably fail, but what the bears have going for them on bar 8 is that the market is testing expected resistance. So strong enough bar on 8 that this may need to get a second leg sideways to down of its own. Just imagine the buy the close bulls. If you're buying closes as a bull anywhere, you're making money all the way through here. But finally, we get a bar 7, that if you bought the close, you're now holding a losing position and you're trapped and disappointed if you bought bar 7. That's going to create resistance at the close and above at the close of bar 7 and above bar 7. And that's what contributes to the resistance that is making a second leg sideways to down for bar 8 likely. I think it's reasonable to exit longs below bar 8, but to sell bar 8 is a little more aggressive because we have a tight channel. The rally is strong to bar 7. It's probably going to hesitate and get a second leg sideways to up before reversing straight down. Bears get a follow through bar on 9. That's good for the bears. The traders who bought bar 7 are trapped and they have not been given an opportunity to exit their trade at break even. And then another bar down. So good for the bears. 3 bar micro channel. Bar 10's a bad stop order buy. There's probably sellers above 10, and you can expect this micro channel to get a second leg down. And then we go outside down 11. So good for the bears. Now it's a tight channel down. You know, any trader buying up here is trapped by this tight bear channel. This is probably going at least a little bit lower. The first reversal attempt will probably fail. So continuing down lower 12, it's probably sell the close and sell above the bar, but now we're back toward the middle of the range, so maybe not ideal for selling the close of bar 12. Maybe selling a pullback is better now that we've pulled back above 10. The market is in the channel phase, so selling at the high of 12 or even in the sell zone of 12 is okay. The market pulls back 13, but still a micro channel to 13. Sell the close, sell above is reasonable because the first reversal attempt is probably going to fail to reverse the market. The bears will probably get a second leg down. That makes bar 14 a bad stop order buy, so sell the close, sell above is reasonable. And then 15, another breakout. At this point, you can count 3 pushes down to bar 10, pullback 12, implied pullback on 13, and then a third push down on 15. We're getting close to the bar 1 low. Most days, bar 1 does not remain the high or the low of the day, so that's a magnet that the market usually gets to. And there's strong momentum down to bar 15, so at this point it looks like we're probably getting to the bar 1 low, so the bears do have an argument for selling bar 15. The problem is it's a big up, big down situation. The market looks like it's in a wide trading range, and the further we go down closer to support, the more likely the market is to reverse. Last time we were here, we got a big rally to yesterday's high. Now we have 3 pushes down near support in a trading range. So selling here is a bit more risky. If you're going to sell bar 15, you need momentum. You need the market to go your way immediately. The bears selling 15 are not selling value. The market is below the moving average, so they're selling below the average price. So they're selling momentum. They're not selling value. And then 16, strong bull breakout bar. So any trader who sold the close 15 is the opposite of what happened up here. Any trader who sold the close 15 is trapped by bar 16 and they're disappointed. And 16 is a bar similar to bar 8 that I think it's reasonable to exit shorts above 16, but to buy above 16 is a little more aggressive because the channel down is tight. So it's a breakout on a higher time frame. The first reversal will probably fail. We may have to go more sideways before the bulls get the reversal. Probably better to... So I thought the fact that the rally pulled back this deep without getting an attempt at a second leg was a lower probability event. This, if bar 16 goes without the bears getting another push, less of a low probability event because of the structure. The bears had 3 legs down already. In this case, the bulls really just had 2 legs, and this micro channel was strong to bar 7. So surprising that the market reversed here, and that creates resistance up here. So if the market does get back up here, like I mentioned, the bar 7 close or yesterday's high, there's probably sellers up here. For 16, reasonable to exit shorts above. Okay to buy 16, but better if there's a second entry long. And then a doji bar 17. You know that there's traders trapped who sold the close 15 because of bar 16. Now we have a trading range bar near the bottom of a trading range. There's probably traders buying below 17. So probably buyers below 17 As far as selling above 17, maybe. You have the first trend line break, so tight bear channel, first trend line break, probably find sellers above and get a test of the lows. But 16 is a strong enough bar, it's probably getting a second leg up, so not ideal for selling above 17. And then 18, bull bar, closing on its high. 3 bar, micro channel, this will probably get a second leg up of its own. And at some point, traders conclude that the market is going higher, so maybe they start buying closes, whether it's 18, cross above the moving average, or a follow-through bar, 19, traders start buying, betting that we're going to test prices where traders got trapped, like the close of bar 7. That's an area of interest for the bulls. There's probably resistance somewhere in this area. So traders are buying closes here, 18, 19, 20. The first reversal will probably fail, so buy the close, buy below is reasonable. Little tail on bar 21 as it tests resistance, but not enough evidence that there's strong selling happening here, that it's reasonable to sell below bar 21. So I want to make that clear. Selling below bar 21 is not a great stop order trade. The bulls have too much momentum. What happened here, I thought, was a lower probability event. And even bar 8 is a warning. You really should not be buying below bar 8. If anything, you can maybe buy below bar 7 or buy below 6. You can even see what happened. The traders, so buying below a strong bear bar, not ideal. But if you buy below the last strong bull bar, like 7, or in this case, bar 6, limit order traders buying below 6 get filled. They have an opportunity to avoid a loss here. Because think about it, if you have a limit order to buy below bar 6, and then you have a 3 bar micro channel against you, it's in your best interest, probably most of the time, to just get out of the trade, because that 3 bar micro channel is probably going to get a second leg. If you think the market's going lower, and the probability is that the market's going lower, it doesn't make sense to buy here. It makes sense to wait and buy more lower, and possibly even sell to go short. So same idea here. There's probably buyers below bar 21. Not an ideal location for buying because we're testing resistance, but the momentum is strong, so the first reversal will probably fail. We can see the pullback on 22, finding buyers below, as there's buyers into the close of the bar. There might be sellers above 22. Momentum is still strong, so not ideal for selling. Better if there's selling pressure that starts to accumulate. But at this point, we are testing an area of resistance. The upside might be limited. 23, bull breakout bar to a new high of the day, but it looks like a wide trading range. Big up, big down, big up. So we're getting big swings, but now we're testing resistance once again. You could draw a channel line based on the trend line. Here's a trend line, here's a low, here's a higher low. You can draw a parallel channel line, so there's a bull channel line up here, probably resistance there. So not ideal, once again, not ideal for buying in this location, bar 23. It's a good looking bull breakout bar, but it's a momentum trade. If you're buying, you're probably scalping out. And if the market starts to hesitate, you're probably going to be quick to exit. You're not buying value. The bulls are not buying value. They're buying momentum. They're buying far above the moving average. Market tests the channel line 24 and finds sellers. Still a 3 bar micro channel, 22 to 24. Not a great stop order sell below the bar. There's probably more buyers below the bar. 24 is not an ideal bar to buy below. Better if you can buy below bar 23. And 25, strong enough bear bar that it may get a small second leg sideways to down, but is 25 enough to reverse all of this buying? Probably not. I think it's reasonable to exit longs below 25, but to sell below 25 is a lot more aggressive, and you have to expect the micro channel or the tight channel, the micro channel 22 to 24, but the entire tight channel from 16 to 24 to cause some hesitation. Think about it, there's always a trader buying and selling, so the bears selling all the way up are getting trapped. So anytime there's going to be any reversal attempt, like when the market fell below 22 or 21 on bar 22, it was quickly bought, and then the market formed a new high in the channel. Strong enough bear bar, you I think traders should respect it. If you're long, reasonable place to exit below the bar, but to go short is not ideal, once again, because of all the momentum. Have to expect a second leg up. 3-bar micro channel, there might be sellers above 26, but they may not come in until higher in the range. Bears might start selling above bars, but when a second leg up is expected, the bears may not sell here. They may wait to sell above 25 or 24. Now for the bears, low one short, but still probably not enough selling pressure to be selling here. Strong enough momentum, still expecting that second leg. There might be more buyers below 27. And then a bull breakout 28, but still, like I said earlier, back here, this is not an ideal location for buying. The bulls that are buying momentum, and they're probably scalping. So 28 might be okay to buy, but the profit target is probably the bar 24 high. Market's in the channel phase and an overall bigger bull channel. And then a bear reversal bar 29, okay to exit longs below 29. But is this enough selling pressure? Is there enough selling pressure from 25 through 29 to reverse all of this buying? I'm not sure. Probably not. And because of you just think about the trader's equation. If you're selling bar 29, you have great risk reward. You know you must have low probability. If you're selling 29, stop above 29, and you're looking for a test of the bull trend line, you might make 6 or 7 or 8 times your risk, but to have such great risk reward, you must have low probability. The probability is that the bull tight channel to 24 is going to get a second leg up. And that's why bears will wait to sell at a new high. So there might be sellers above 29 instead of below 29. But I did say 25 was strong enough for a second leg sideways to down. Maybe the bears get a second leg sideways here. And then 30, looks like we triggered the sell below the bar, trapping traders into the short. And then, so I said, maybe I didn't mention this, if you're selling 29, you're taking a good risk reward but low probability trade. And if you're selling 29, the stop does not go above 29. It's a skunk stop location. This is something I've been paying a lot more attention to lately. That is skunk stop locations. If a signal forces a trader to put their stop in a location that doesn't make sense, it's really probably not the greatest trade. So if you're selling below 29, stop above 29, think about what you're doing. You're saying your premise is invalid if the market goes above 29, but the bulls are expected to get some kind of second leg after all of this buying, and there's expected to be sellers above 24 because the market has transitioned into the channel phase. So it really doesn't make sense to sell below 29 and then put a stop loss above 29 or above 24 at a new high to buy back shorts. You'd be buying exactly where strong bulls and bears are selling. You'd be buying at resistance, so it doesn't make sense, and that's why it's a skunk stop. 30 traps traders into the trade and then immediately runs the skunk stops. There's probably sellers here as the market breaks out to a new high in the channel phase, but tight enough channel, 26 through 30, this may get a second leg up of its own. Some hesitation as there's probably profit taking from the bulls. I think bar 31 is produced from bulls taking profits more than bears selling. Probably buyers below 31, bad stop order sell. Market continuing to channel up here, probably buyers below 32 and 33. Not enough selling pressure. But another breakout 34. Now we have 3 pushes. 29, pullback, 30 or 32, pause, and then 34. So that's 3 pushes up, nested 3 pushes. Let's see if I can draw it here. So 1, 2, 3. Bigger picture, 1, 2, 3. So 34, really not great for buying. Good location for the bulls to be taking profits because it's testing 2 channel lines. So it's late in the channel phase, leg 3, far above the moving average. If you're buying 34, you need momentum right away. Once again, this is a momentum trade for the bulls, not a value trade. So if you're buying 34, the trade has to go your way quickly. And if it doesn't, bulls will exit. Hesitation is disappointing when you're buying momentum, so there's probably sellers on the close of 35, sellers above 35. 36 high one buy. It's possible this tight channel gets another leg up, but the upside is becoming limited. This is a tight trading range, probably sellers above 34, sellers above 37. Tight trading range continuing, limit order market, expect sellers above and buyers below. And 39, now we have a 3-bar micro channel, 37 through 39, not especially strong, a couple of, it's really all trading range bars, but it's a bad location for buying, and if it's bad for buying, it makes sense to sell. So probably sellers above 39. It looks like 41 outside down. Now it's a tight enough channel that any trader who was buying up here, if you, let's say a stop order bull, sees a tight channel, they buy above 36, they're trapped. Now it's a 4-bar tight channel against them. They're probably selling above bars. And that means a second leg down after this is likely. Bears get another follow-through bar, but the first test of the moving average in about 20 bars, which is support, so we'll probably bounce here. Bounce means minor reversal. Tight channel, 37 to 41. That'll probably get a second leg down. It's a breakout on a higher time frame. Probably sellers above 40 and 41. 42, big bull bar, but testing resistance. Remember what happened back here. I mentioned you always have to be thinking that there's, in theory, there's traders buying and selling on every tick. Anyone who bought above 36, just imagine you bought 36. Here's your entry bar, the next bar, market's going sideways. You're buying far above the moving average. That's already disappointing. Market maybe gives you a brief opportunity to exit. And if you didn't take it, you get another chance on 42 as the market tests resistance. Remember, tight channel down to 41, second leg down likely because of those trapped traders. The market tests resistance on 42, getting a deep pullback, but still expecting a second leg down. So there's probably sellers up here around the bar 36, the high of bar 36. 43, bears get that second leg, in this case sideways. Leg 1, pullback. Leg 2, testing support, 3 legs down, 1, 2, 3. So we might bounce here. But 43 is strong enough, it may need to go more sideways before reversing. By that, I mean 43 is a strong enough bar. Anyone who bought 42 is trapped by 43. That creates resistance above and may get a second leg down as they get on 45. So it's a pretty tight channel down for the bears here. Testing a channel line once again, so we might bounce here. But the bears are now getting this pullback. The bulls are hoping, so it's a tight bull channel, maybe 3 legs down to the moving average. Bulls are hoping it's a wedge bull flag they can buy, and then the market breaks out to a new high. The bears are hoping for the opposite, that it's an endless pullback and that we continue down lower, and that ultimately today's a trading range day. Follow through bar, 4-bar micro channel down to 46, bad stop order buy above the bar, probably sellers above 46. Same goes for 47. Micro channel, another bar added to it. Bad stop order buy, reasonable limit order sell above the bar, which triggers on 48 and immediately continues lower. Tight channel, still expecting lower prices. Once again, you can count 1, 2, 3 legs down near bar 49. So there might be profit-taking bears below the bar. Not an ideal location for selling, but to formulate an argument for buying here is difficult. The bulls don't have much buying pressure since bar 43. So this is a breakout on a higher time frame. On the 5-minute, we see a micro channel down to 47. Once it pulls back, technically, it's not a micro channel anymore, but a tight channel. But once again, strong enough selling that you have to expect a second leg down, and any reversal will be minor. So even if it's 3 legs down, you expect a minor reversal, a pullback, but then trend resumption back down. So market bounces here after 3 pushes down, but 50, strong bar, but a couple problems with bar 50. The first problem is, once again I said, tight channel 43 to 49, so expect a minor reversal. So do expect a bounce, but not a major reversal. Another problem with bar 50 is you look back to the left and there's an open gap. the traders who bought below 44 are trapped by the breakout 45, maybe, let's see, low 75.57 and a quarter, the high 57, so there's a one tick gap between the low of bar 44 and the high of bar 46. And that is trapped traders. It's a sign of strength for the bears. It's very subtle, but it's there. There's an open gap, and that's good for the bears. I'm mentioning that here because look at bar 50. It's approaching that resistance area. So one of the things Al talks about in the course is don't do dumb things. And an example of a dumb thing would be buying at resistance. In a tight channel where there's an open gap, bar 50 is really the first reversal attempt, and it's testing an area of resistance. So it really does not make sense to buy bar 50. There might be buyers below 50, and there probably are. It's a strong bar, but the traders are not buying the close of 50. More likely, it's a tight channel, 50% pullback, testing a gap, testing the moving average. There's probably sellers on the close of 50. The market turns back down. I said there's probably buyers below 50, but if you set a limit order to buy below 50, look at the market's approach. 1 bar, 2 bar, 3 bars against you. Strong bear breakout bar closing on its low below, really many bars to the left, but below bar 50. So really not what you want to see if you're buying the low of bar 50. If you bought the low of 50, you're just hoping the market pulls back and allows you to exit at break even. Now it's a new micro channel down to 53. Expect a second leg down, but as we approach the channel line here, there might be buyers below 53, bears taking profits. So little tail on 54, maybe some profit taking, but the channel down is still tight. It's a breakout on a higher time frame. Have to expect lower prices. Micro channel 50 to 54. Bad stop order buy 54. Expect sellers above the bar. We go outside down 55. Tight channel, still expecting lower prices. Consecutive trading range bars in leg 3 in the channel. So we might pause here again. Once again, we might get a minor reversal, but the channel down is strong enough that I expect just a minor reversal, a bounce, but then ultimately more down, a second leg down. So 57 breaking out, but breaking below this bear channel line, so not ideal for selling. If you're selling 57, you want to see momentum right away. You're selling far below the moving average, so you're not selling value. It's a momentum trade, and it's leg 3 in a channel, so the expectation is that the market bounces and corrects for a couple of legs sideways to up, but the channel is tight. There's a bear trend line, and there's probably sellers at the bear trend line. Also, I mentioned the bar 50 low, probably buyers there, but those who bought below 50 are trapped, and there's still an open gap there. So once again, sign of strength by the bears. This is a strong leg. We're probably going lower. It's possible that this is maybe leg 1, pullback, leg 2, pullback, and maybe we get a third leg down. I'll keep that for now because the trend line is expected to be resistance. 58, bull breakout bar, but tail above the bar. Expect sellers above 57. Also expect sellers above 58. Expect the reversal attempt here to be minor. A lot more selling than buying. And the bulls probably need a trendline break and a test of the lows before there's any reversal. Testing near the trend line, finding resistance as expected. Maybe. So what about selling below 59? Well, the market moved a fair distance from the close of 57 to the high of 59. So once again, just put yourself in the shoes of the traders who sell the close 57. They're trapped 58, 59. That's going to create support. So there's probably buyers down here below 59. The bulls may get a second leg, but ultimately expect this to be a minor reversal and then lead to trend resumption. But remember, it could be 3 legs down, might need a 2-legged pullback. 60. So you could count that as 2 legs. 1, pause, 2. You can call it 3 legs. 1, 2, 3 to bar 60 and testing resistance. So 60, not a great buy. If anything, we're probably going to go pull back more because we have 3 legs on the lower time frame. So the bulls, bar 60 is a third leg at a channel line. Bulls will take profits and bears will sell, expecting trend resumption, but it is a 3-bar micro channel, so there might be buyers below 60 and a second leg up. 61 testing that bar 57 close and bouncing, so finding some support. And once again, 3-bar micro channel, although it's not the strongest micro channel. It's got a couple of trading range bars, especially bar 59. And there's no micro gap, so there's a lot of overlap, and it's counter trend. But we can see there were trapped traders, those who sold 57 trapped by the rally, buying back shorts, and that can create a small second leg sideways to up, which we're starting to get here on 62. But still on that trend line, probably sellers above 62. Try to clean up the chart a little bit so we can see more clearly. Entering a tight trading range, we've been sideways for maybe 6 or 7 bars, probably sellers above 67 and 63 and 60. As far as buying at the low of the range, maybe okay, but enough momentum going down into this and not enough bars in this trading range. It's probably a bear flag, and the bears are probably going to get a second leg down. So we can see limit order traders come in near resistance in this trading range. You can call it a trading range, but bigger picture, it's a bear flag. 64, reasonable stop order sell below the bar. Low 2, short, bear breakout, low 1, pullback, low 2. It's actually a nested low 2. So you have leg 1, pullback, leg 2, but also here from the 61 low to the 62 high might be leg 1 on a lower time frame, pullback 63, leg 2 to the high of 64. And then possible trend resumption below 64. Decent signal bar. I think selling below 64 is reasonable, but stop above 64, not ideal. Skunk stop location, there's probably sellers up here. So if you sell 64, have to be willing to scale in and sell more higher, not buy back shorts exactly at resistance. 65 bull reversal bar, but leg 3 counter trend. Remember the leg count. 1, pullback, 2, pullback, 3. Now it's a wedge bear flag. Traders will sell to close. 65. The bulls really need a follow-through bar here, and they're not likely to get it. Most breakouts of trading ranges fail. The market's just below resistance. Remember what I said. Don't do dumb things. Don't buy at resistance. Strong-looking bar, but terrible location. Leg 3 against a trend. So sellers above 65. Sell to close 65, more likely. 66. Small trading range bar. So it looks like this trading range is continuing. Okay to sell above the bar. I think being long is not ideal because it's already 3 legs near resistance in a bear swing. Bear breakout bar 67. It's possible this is trend resumption for the bears. And a decent pair of bear bars, there's probably sellers above 67. And once again, tight channel, 50 or 51 down to 57, expecting a second leg down, which means the bears have a leg 1 equals leg 2 target somewhere down here. And a measured move of this bear flag, this trading range, takes you exactly to the same spot. This line is covering that leg 1, leg 2 line I just drew. So a couple of magnets here. Looks like a minor reversal, not a major reversal. And tight bear channel, 3-legged pullback. This could be, once again, this could be trend resumption. So selling 67 is okay. Selling above the bar, also reasonable. Pause bar, 3-bar micro channel. Sellers above, more likely. But in the middle of the range, so the sellers may not come in until higher in the range. And then we get a bear breakout, 69, 4-bar micro channel. This looks like it could be trend resumption for the bears. It's breaking out below all the bars to the left and closing near its low. That's good for the bears. 69 is reasonable to sell and reasonable to sell and scale in higher, betting that the first reversal fails. So 70, a reversal for the bulls, but the problem I have with buying bar 70 is that it's following a 4-bar micro channel. So expect this micro channel to get a second leg down. Bigger picture, this is a bear breakout on a higher time frame. This is a pullback. This might be trend resumption. This might just be a minor reversal. Market tested support. So this trading range, remember I said, if this is a trading range, you want to sell, buy low and sell high. I think selling, limit order selling is reasonable, but to buy is more risky because it's against the trend. The trend is down, then there's a trading range, which you can call a bear flag, and then you expect trend resumption down. There might be buyers below 57, the bottom of the range, but I think it's less ideal because you're trading against the trend. But there is a bounce on 70, so there is some buying here. But is it enough to reverse this selling? Probably not. Was this enough buying for traders to conclude this is a bear trend, trend line break, retest, lower low, major trend reversal? Maybe, but major trend reversals are successful only about 40% of the time. More often they become flags and continuation patterns or simply trading ranges. So 70 not likely to lead to a major reversal. Short term, more simple, 4-bar micro channel, expect sellers above and second leg down. The market continues down here, channeling down. 72, now it's maybe a second entry long 72, but doji bar. It's actually looks like technically a micro channel down to 71, so there's more likely sellers above, which we found on 72. Trading range bar after micro channel, expect a second leg down, sellers above, so 72 really not great for buying. Bad stop order buy, limit order sell above the bar is reasonable. Continuing lower, 73, 74. Strong pair of bear bars approaching the magnet, couple of magnets, leg 1, pullback, leg 2, and measured move of this bear flag, the trading range. So there might be some support down here. Also, 1 pullback, 2 pullback, 3 legs down, breaking below a channel line. Also an incentive for bears to be taking profits. So bears buying in this area at channel lines and measured move targets. For the bulls, look back, way back to the left, and in this area is support. Strong bear bar, 15. Market broke above it. And then got this strong rally starting in this area. And that's another reason there might be buyers in this area. 75, strong bull breakout bar, but against the tight channel, expect sellers above and a second leg down. So a strong enough bar that there's probably buyers below 75, but to buy 75, the close or the high, not ideal. Strong enough momentum, this reversal should be minor and produce a second leg down. 76, testing the moving average. Pair of bull bars is good for the bulls, but in a bad location for the buying. And then 76, market broke to the upside but reversed back down. 76 or 77, outside down. Talking about the leg 1 pullback, leg 2 pattern, leg 1 pullback, leg 2, maybe leg 1 pullback, leg 2. Tight channel, 64 to 74. Deep pullback, but testing resistance. This was an open gap, 66 low, 68 high. Open gap, trap traders, market tests it, and then reverses back down. And I said there's probably buyers below 75, not ideal to buy here or here. So this may produce, this tight channel may get a second leg down, but then there might be buyers below 75 and 74 at this magnet, the bear target. Also, those who sold to close 74, trapped by 75, that also creates support. So expect buyers down here. So 78, big bear trend bar, good for the bears. At least it looks good for the bears, but testing support. So 78, really not an ideal bar for selling based on the context and its location. Time of day also plays a role, but this is assuming it wasn't bar 78, just purely based on price action. 78 is not a great sell because it's on a bear channel line. It's testing several measured move targets for the bears, and we just had this rally 75 to the high of 77. Those who sold the close 74 are trapped. This may start to go more sideways or even up as it evolves into a weaker channel or a trading range. There's probably buyers below 75, and at this measure move target, like I said, 79, big bull breakout bar, but then the bar ultimately came back down to its close. So it's a trading range bar. The market went up and then it went down. So there's buying happening on bar 79, probably bears taking profits, maybe some bulls buying, expecting a second leg sideways after this rally. Strong enough bull breakout, buyers below, bulls come in and buy below, and they capture a second leg. 79, same location as 78, but an even bigger bar. So the risk is huge. Location's bad for selling. There's probably buyers below 79. Then we find buyers below 79, and then the market reverses back up bar. What is that bar? 81. But now we're back at the top of the range, testing resistance. Yesterday's high, the bar 79 high. But of course, out of time on the RTH chart. That's it for today. So thanks everybody for tuning in for today's end of day review. For more price action fundamentals and how to trade price action, please visit the link in the description, thebrookstradingcourse.com. Once again, thanks everybody for watching today, and I hope everybody has a good night.